Good day and welcome to Money Matters TV. My name is Doug Hepburn with Hepburn Financial Advisors, offering securities through Cetera Advisors and investment advisory services as well. Cetera is a member of FINRA, SIPC, and a broker-dealer registered investment advisor. Cetera is under separate ownership from any other entity. My guest host today is Ken Jordan from Round Point Mortgage. Ken?
How are you doing?
Good.
I'm doing well. I hope you're doing well. I think we're doing well. So we are again, and talking about some of our favorite money matters topics.
Right, real estate,
and
mortgage rates.
Yeah, interest rates, exactly. Some interesting things since the last time we were together. Mortgage applications continue to fall, and they were down the end of last week of May. They were down 2.3%, down to its lowest level in 4 years, believe it or not.
Right.
So the industry is going to continue to contract for a lot of reasons. I'm sure most of which we'll talk about today. But it's going in the direction we expected it to go. As interest rates continue to go up.
Yeah. Well, and that could perhaps be a good thing. When any market gets overheated, you have to kind of slow things down. You don't want it to run away. I mean, that's been the big concern for a lot of people is inflation, because we've seen prices tick up, particularly in the more volatile areas of food and energy.
Yeah.
But even in the core CPI or Consumer Price Index, that's actually gone up significantly as well, and it causes people to be concerned. But there's help on the way.
So, it's funny you say that, because I was reading, we were talking about the term quantitative easing, and now we're starting to hear a new term, quantitative tightening. Tell me about quantitative tightening and our listeners exactly what that is.
I think we're going to hear a lot about quantitative tightening. So, when the Federal Reserve Bank has two mandates. One is full employment, and that's the first one. The second one is price stability. And what that means is, the goal of the Federal Reserve is to get as many people working as possible that are eligible to work and want to work, while keeping inflation from getting out of control. Well, traditionally, the Fed has only had a couple of tools at their disposal, like buying and selling bonds in the marketplace, which has been a short-term thing. But more importantly, the federal funds rate, which is the rate at which they lend to member banks, and the discount rate. Most people focus on the federal funds rate, which for a long time was down around zero to 0.25%. Well, for the federal funds rate is just for overnight loans to different member banks. So it's really short-term interest rates. But if long-term rates are way down, the Fed doesn't, or out of sync, the Fed for a long time did not have many tools at its disposal. So what we saw after the great financial crisis of 2008 was quantitative easing, where the Fed bought all these bonds, 30-year bonds, 10-year bonds, to be able to lower interest rates at what we call the long end of the curve.
Sure. So they were buying bonds so that they could increase demand for those bonds, which drives down the price of those bonds, keeping interest rates low. Is that correct?
It does a couple of things. One, by buying the bonds, so bonds and bond values, principal values and interest rates move in opposite directions. So when interest rates go down, bond values go up. That's the first thing to remember. So when the Fed's out there buying bonds and creating competition for these long-term bonds, interest rates go down because people are selling their bonds for higher prices. What happens is when they do that, people now have money and they turn around and either buy more bonds or they spend it, invest it somewhere else. So by buying the long end of the curve, which was quantitative tightening, that injected more money into the economy and allowed the economy to sort of come off of the great financial crisis. Well, now we're at a point where the economy is starting to overheat due to what's known as fiscal policy, the federal government spending lots of money. And as a result, when you have too much money chasing too few goods, you get inflation. So what the Fed has done is they've already started doing 50 basis point or 0.5% hikes at each meeting, and they're expected to do 3 to 4 this year. So we're probably going to see the federal funds rate, which used to be at 25 basis points or 0.25%, go up somewhere around 3%. But that really only affects the shorter end of the curve, shorter end of the yield curve. And you heard a lot of people talk about this in the past few months, yield curve inversion, where short-term rates are higher than long-term rates. And when people hear that, that's usually a sign that the economy is going into a recession, because the Federal Reserve has caused more recessions than anyone. Because the economy heats up, they raise interest rates, things slow down, and the economy contracts. Well, quantitative tightening is selling all those bonds, not all of them at once, but systematically selling those bonds that are at the longer end of the curve that the Federal Reserve bought maybe 10 years ago or 5 years ago. And the process begins with not reinvesting the interest that those bonds are earning. So the Fed has already signaled liftoff in the federal funds rate, and now they're signaling that quantitative tightening, selling these bonds at the long end of the curve, is going to occur. This is actually a good thing, because what it means is instead of the yield curve getting inverted with short-term rates higher than long-term rates, it allows for longer-term rates to adjust and a steep yield curve to exist.
And that's healthy.
And that's healthy. And look, the reality is the Federal Reserve has distorted the interest rate market for the past 10 years by being the 800-pound gorilla buying bonds.
Mm-hmm.
Well, now if they're going to slow that down, we're probably going to see more normalized interest rate policy, and that creates change, opportunity, which will eventually slow down the economy.
And we're going to see the federal funds rate is going to impact consumer lending in the immediate term, right? I mean, anything that's tied to prime rate, whether it's a home equity line of credit or
credit
card, which is big. Yeah. I know that from a debt standpoint, our statistically, as a nation, we are in a better place today from a debt standpoint than we have been in previous cycles. Consumer debt, correct. Credit card debt, they have less debt. I know that with the amount of equity that we have in our homes, that has given a lot of homeowners the opportunity to tap into some of their mortgage equity to offset and pay off their short-term debt. So that's a good thing. But I guess we'll just, we'll have to see, especially when everybody knows interest rates on the mortgage side are going to go up, but nobody has that magic number. What's it going to hit and where's it going to stop? I think there's a little bit of fear tied around that number because nobody really knows what it's going to be. But your crystal ball's out, Doug. What do you think the top of the market's going to be as far as interest rates go in the next 18 months?
Well, that's a great question. I had a strategist ask me this. It's probably going to be over 2.5%.
Over 2.5%, the federal funds rate.
Federal funds rate, we're probably going to see the 10-year, I'm guessing around 3.5%.
And if that's the case, then we should see mortgage rates probably in the high sixes as the top end, 6.7 or 6.75, 6.6 and 5/8, somewhere in that ballpark. If those relationships all stay, the way they have in years past, would you agree?
Absolutely. And you know what that does? That raises, that piques the interest of some of our viewers. In particular, one viewer, Frank Tillman of Philadelphia, asked, why are the prices of houses still going up while interest rates are also going up?
Wow, Frank, that is a phenomenal question. And here's the answer. This has been a supply side problem that we're facing right now in the real estate industry. And our guest, who is going to be coming on in a couple of minutes, definitely can speak to this. while the interest rates impact affordability, so affordability impacts demand. If less people can afford the inventory that's out there, then that would obviously decrease the demand for the inventory that's out there. But you can, and by some calculations, almost 40% of the demand has disappeared as a result of higher interest rates. But what's left is still too much demand for the supply that's out there, and that's the main problem. Now, it's a supply side issue. We're not building enough. We're not providing enough new housing, bringing enough new housing into the market to meet the demand. And until that changes, we're going to continue to see house prices go up. Maybe not at the same trajectory. Maybe it'll go up a little bit slower. And I know our guests will talk about this a little bit as well. But that's why the interest rates haven't hit a critical point where it's completely shut down or even found equilibrium with the demand. But that's the reason why interest rates are going up, yet house prices are still going up as well.
Great answer, Ken.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Guest today, Todd Reed from Keller Williams in Downingtown. Todd is in the residential real estate market. Todd, welcome to Money Matters TV.
Hi, Doug. Appreciate you. Thanks for having me. Hello, Ken.
Hi, Todd. How are you?
I'm good. Thank you.
I know it sounds like kind of a crazy question after the shows we've done in the past and what we just talked about, but how has the real estate market been this year?
Well, Ken just touched on it pretty well. Supply and demand issue. There's plenty of demand and not enough supply for some of the reasons Ken mentioned. And, that there has to be a way for that to change, or the market's not going to change. There's not enough affordable new construction, and that's not going to change easily with prices of ground and materials and the overall cost to build a product being so high. It's easy to say, let's build more affordable housing. It's just not that easy to achieve. So I don't think the market's going to change anytime in the near future.
So that's got to be good for the construction industry. You would think, right?
Exactly. Again, there's pros and cons to that.
Yes.
Todd, you mentioned that the inventory partially has fueled this, and obviously I'm in agreement with that. When we talk about inventory, what are some of the metrics that you as an agent, what do the real estate community use to gauge, okay, our inventory? I believe there's some measure where you look at how many houses are on the market or the number of months worth of inventory. I was hoping you could maybe talk about that. And then do you see any of that changing? New construction is an issue, but what are some of the things you think may impact that inventory level so that so we'll start to be able to watch and see, okay, this is some of the things that we're looking for to find that inventory balance.
Yeah, and you're right, Ken. There is a formula for that. It's basically the homes currently on the market should be roughly a 3-month supply of inventory for the people that currently want to buy homes. So if everyone were able to buy, the current inventory would disappear within 3 months. There hasn't been a 3-month supply of inventory. We're lucky if it's 1 month. And it has to start with a lower end price change, because if the lower end person can't find a home to buy in an intermediate price range, they're not going to put their home on the market to sell. And the intermediate seller cannot find a home to buy in the upper end price range because there's nothing for sale. So he's not going to put his home on the market. So the chain is currently broken, and that chain just needs to change somehow. Certainly, and you can speak to this probably better than me, but rising interest rates, the Fed, the government has a game plan to slow things down. And I do feel it's changing a little bit. I think the last month and a half has been a little bit slower than it had been. For a while, And real estate generally is regional, but I can speak for almost the entire United States. There hasn't been enough for sale. When you put a home on the market in the old world, you're looking for an offer. In this year, you would get 6, 8, 10 offers. And that's not healthy. If you're the seller, you love that because, hey, people are fighting for your property and trying to overbid each other and you got top dollar. For the buyers, obviously, if a property has 8 offers and only 1 can be accepted, 7 people did not get the property and they have to start that process all over. So rising interest rates will help change that. Just the entire, obviously a lot of side effects of the pandemic are still affecting the market, and that will all shake out here eventually. I'd be surprised if it happens anytime this year. It's going to take time.
That's interesting that the situation you put out there, that people who are typically selling a house at the entry level, first time home buyers, are looking to move up, and that makes perfect sense. But how are they going to move up if there's no inventory in the middle market? And so I guess the question that I have is that real estate's, you hear that old saying, it's location, location, location. And so it's very, very regional, even by neighborhood. Are we seeing the same thing around the country?
We are, and that's really unusual. Typically, I'm more in the mid-Atlantic to Northeast region myself, near Philadelphia, and I wouldn't pay much attention to the California market or Florida or Texas or the Midwest. That had nothing to do with my market. My market could have been red hot, and maybe the South was very slow, or vice versa. This, in the last year, that is opposite, where the entire country's in the same boat. I have talked to a realtor in Texas recently, and when he would list a property for sale, I forget what town he was in, he told me they would get at least 40 offers. And that's, again, it's not healthy. One person gets the property. What happened to the other 39? I had a local customer of mine that just recently bought a vacation home in Boca Raton, Florida. And they bid on, 5 or 6 or maybe 7 properties that they got outbid on before they finally got one. And the one that they got, they bought sight unseen. Their realtor went in and videotaped it for them, but they never got to see it. The good news is, I know that when they finally made closing on a property, they did go down to see it and they loved it. So that was good news. But it is, the whole country has this same inventory problem.
It's but I think it's interesting, the buyers, obviously it's great for sellers, but what are some of the risks that buyers are taking on right now that would be unthought of in the past when they're putting in their offers in an effort to win a bid?
Yeah, Ken, that's a great question, because we are seeing buyers do things that they maybe shouldn't do, but they're desperate. If you're a buyer and you bid on 3, 4, 5 homes, for example, and you've got outbid on all of those homes, eventually you say, hey, I've had enough of this. The next home that comes on the market that fits my criteria, we're going to do whatever it takes to make sure we get this property. They're waiving inspections. In a typical market, almost every buyer was doing a home inspection, a termite inspection, potentially a radon test. If a property had an on-site well, they would test the well. If it had an on-site septic system, they would do a sewer test. So at least in my area, a lot of home buyers were doing 5 inspections. Right now, you have buyers waiving all of those inspections. Ken, you even have buyers waiving mortgage contingencies. So they may be planning to get a mortgage, but they're waiving that contingency. So if for some reason they get into the deal prior to closing and cannot get a mortgage, they don't have that out, and they run the risk of losing their deposit, their escrow.
I got to throw you a curveball here, because you just made me think, if you look at the stock market, particularly when markets go down or are in a sell-off, kind of like what we've seen, there's usually a point of what most analysts call capitulation, where people just throw in the towel. that's it, I'm done. And a certain portion of the market investors will cash in. And that's usually the bottom point in the market. I think the same could be said somewhere at the top, although it's not as easy to tell, because particularly in an equities market, although in an equities market things move a little bit faster. What about the real estate market? How do we know when the market's capitulated? People have thrown in the towel and they're no longer going to play this game of trying to outbid everybody else.
Yeah, and you have some of that happening now, Doug. Frustration. You certainly have maybe a current homeowner that really prefers to move. Maybe they want a newer property, a different location, but they're frustrated with this market, and maybe they stay right where they're at and improve their current property. So you are seeing folks, hey, we're going to put in a new kitchen. We're going to put in a couple new bathrooms. We need more space. We're going to put an addition on the property for some more square footage, finish the basement. You already have people that, because of that frustration, have thrown that towel in, and they've decided not to move. And talking about the first-time home buyer market, that segment of the market, a lot of younger people, let's say 30-year-old range couples, a couple years out of college, they've saved a few dollars and they really prefer to buy, but they have become so frustrated with this market that maybe they go ahead into a rental for a year, sign a 1-year lease. They don't really want to do that, or extend the current lease where they're currently renting. And they're just going to wait out the market and hope that next year it will be different, maybe more in their favor. It's
funny you say that, Todd, because, I have seen that, people who are pre-approve a borrower for getting out there and looking at houses. In a normal market, our pre-approvals have usually run at about a 25 to 30% conversion rate. Every pre-approval you do, take out some that don't qualify, take out some that, end up not buying. And then, the rest end up converting at some point to a contract. That number is now down to almost 15, 18% in a lot of cases. And the people that are, quote unquote, giving up on the purchase market, they do have equity in their house. And sometimes there is an argument to be made, like, look, you can go out and pay top dollar for the house you're looking for. Or if you, even with interest rates higher, you could create what you're looking for here, and there's value there. And I think we are seeing a little bit of that. And also, the construction trades are still overburdened. So even though people do want to fix the house they're living in, it doesn't necessarily mean they're going to be able to do it right away, just because of the lack of, we're having issues with, availability of construction and contractors, So I think that's pretty interesting. I do have a question though. Considering what we've learned about the ability for people to work from home, are you surprised we're not seeing more mobility in the buyers in the marketplace? Because, obviously all real estate is local. Are there any markets out there where, say, the Philadelphia marketplace, my affordability might be running out, if I'm a home buyer, but I might be able to afford something in another market? Are you seeing a migration of buyers looking for affordability opportunities, in the last, let's say, 6 months? Or do you think that's something that will become a trend?
Well, I think you see some of that now. Example for me personally, I have had a couple recent sellers that could not find anything here to purchase, but they also owned beach properties or second vacation properties. And I sold a couple homes last year, and there was nothing really for them to buy. So they moved into their vacation rental properties because they were working remotely. It did not matter where they lived. So they actually moved full-time into a property that maybe they were only using a few weeks a year. So that's definitely happening some, Ken.
I'm sure we'll probably see more of it too.
Would not surprise me at all. It looks like maybe there are companies where employees will never go back, or, the ones that do, it seems to be even on a part-time basis. Maybe you only have to go in the office 1 or 2 days a week now. And maybe that commute's an hour and a half. But, if you're only doing it once, twice a week, you say, I can handle that. If you had to do it 5 or 6 days a week, it would get old.
Agreed.
Yeah.
With that in mind, and obviously, look, everybody wants to move into the nicest neighborhood possible. And that's going to drive up prices in those areas. But you also see there's some neighborhoods, some places, in particular, the city of Philadelphia, I think has more inventory than the 5 counties surrounding, or 4 counties surrounding Philadelphia. And so I guess the question is, does that mean that we're going to see a lot more people buying in value areas, if you will, places that have been undervalued for a long time, and fixing those up? Gentrification?
Yeah, I think you'll see some of that. Why not? Again, that's really an affordability issue. Everyone has their perfect set of criteria. I would love to
Right.
live in this location with this many bedrooms, this many bathrooms, and this size of lot. But buyers need to be flexible. So yeah, Doug, that's part of their flexibility right now. Maybe moving to an area that is not number one on their list, but they're going to make it work because maybe that's an area that fits within their budget. Especially, again, we know that earlier this year, rates were in that fixed rates 3.5%. Today, Ken will tell you we're probably 5.5%. That's definitely affected the affordability. So yes, I think buyers will be more flexible and maybe move to their second choice as opposed to their first choice.
So what can potential buyers do to get to buy a house, to be in a competitive market like this, to position themselves better in this competitive market?
Yeah, Doug, two key things. More money down. Hey, nothing like save as much money as you can while you can. If you're living at home, obviously that's the way to do it. I know it's not easy to say, hey, save a lot of money when you're paying a big rental payment, but more down money makes you a more attractive buyer. Always better credit score. When again, buyers are competing for a property and one buyer is putting 5% down and the other buyer is putting 20% down, the seller will look at the buyer with 20% down as much less risk, and they will lean towards taking that offer. So save money, keep working on that credit score, be flexible. Those are the best things a buyer can do in today's market.
Fantastic. Very good advice, Todd. Thanks for being our guest today on Money Matters TV.
Thank you. Thanks for having me. I appreciate you guys inviting me. I really, I thank you for that.
Yeah, man, it was a great conversation.
Yeah, absolutely. Ken, thanks for co-hosting today. On our next show, our guest will be Chuck Baldwin of Baldwin Clark, and I'm sure that's going to be a great episode. So make sure you come back and watch the show, because at Money Matters TV, we're here because your money matters.